So at this point, we would like now to hear from the other side, our financial sector. In this session, we would like to know how are the financial institutions extending financial relief to the hospitals and their suppliers, and how do they promote continued access to financial services and hasten the recovery and sustainability of their businesses during and post crisis period. We are privileged to have with us the president of the Bankers Association of the Philippines, who is also the president and CEO of Bank of the Philippine Islands. You can see his entire profile on our website. Ladies and gentlemen, my honor to present to you Mr. Cezar Consing.
Well, good afternoon, Professor Alumno, and greetings to my fellow panelists, Dr. Jaime Almora, USEC Rosario Vergere, PCCI President Emeritus George Barcelon, and Executive Director Maria Corazon Dichosa. Thank you for the invitation. I'll give a few remarks and then pass it on to my colleague, Jovi Alonso, who is Chief Credit Officer of BPI, who will talk about some of the issues we deal with when we look at hospitals and financing hospital operations. But first, a quick overview. The country's credit metrics clearly remain very strong. The debt to GDP levels are fairly low. The peso has strengthened over the last few months, and we have maintained our BBB plus sovereign credit rating. But the strong credit rating is not necessarily equal to economic well-being, as you well know. They aren't quite the same. And if you look at all the BBB plus countries in the world, the Philippines is probably the poorest in terms of per capita income of the world's countries that are rated BBB plus. The Undersecretary and Mr. Barcelon talked and referred to low medical spend per capita relative to other countries. And this is just a proxy of the issue that I've just raised. This year, when you look at the growth rates that we've been seeing quarter on quarter, it's easy to imagine that GDP growth for the year will be in the order of negative 10% for the full year. Just to put that in perspective, for those of you who are old enough to remember, and I suspect that's a minority, of course, George and I will remember this. During the debt restructuring crisis of the early 80s, we had a couple of years, 84 and 85, where the Philippines grew by negative 7% a year. So in other words, the country shrank for 2 consecutive years. In the Asian financial crisis, the crisis that ran from 98 to about 2002 or 2003, in the very first year of that crisis, the Philippines shrank by about 2 or 3%. So that gives you an idea of the magnitude of shrinking in the order of, call it 10%, maybe more. Fortunately, by every indication, we are seeing green shoots of growth throughout the country as the lockdown lightens and the economy opens up. And so I would not expect 2 consecutive years of negative growth. In fact, next year, we expect quite buoyant growth, something in the order of 7, maybe 8%. That being said, full recovery will not come back until probably the year after, 2022. If you look at loan growth this year, in other words, credit growth, as of the end of the third quarter, it was only tracking 2.8% year on year. This is the lowest growth rate we've had in more than 10 years. And it reflects the fact that times are more difficult and aggregate demand is low. What surprises me personally is if you would have asked me what would have happened to the healthcare sector in a crisis like this, I would have told you, without knowing what has since happened, that the healthcare sector would be very robust, that in fact it would be buoyant. And so I'm asking myself, why is it in a time like this that the healthcare sector is actually quite challenged, right? When it is so important to everything we do right now, it is so central to our lives. By our estimates, the gross value added of the healthcare sector this year will only be about 86% of 2019 level. So that's a drop of 14%. That means the healthcare sector is shrinking faster than the economy as a whole. And when you think of how central it is to our lives now, it really raises the issue, what is happening? Okay? By most indications, the healthcare sector will recover with the economy. And by our estimates, we should be back to gross value added levels that we saw in 2019 by 2022. So we think that's probably a year and a half, 2 years away. When I talk to my colleagues about economic metrics, I ask them, forget about looking at -10, -11% growth rates. Just think in terms of how long it will take to get back to pre-COVID levels. And by that measure, we think for the healthcare sector, it's probably the order of 1.5 to 2 years. What surprises me about the negative growth that we've seen in the healthcare sector this year is that in a situation like this, it's almost like a utility, or it should be a utility. In fact, when you look at the other utilities in the country, telecoms, water, power, they are pretty much, or by the end of this year, they will be back to pre-COVID levels in terms of gross value added. But we don't see this in the healthcare sector. So with that, what I'd like to do is pass on the floor to my colleague, Jovi Alonso, who is the Chief Credit Officer of BPI. And he will go through some of the issues we see that are fairly unique to your sector and explain why things are the way they are. Thank you very much.
Thank you so much, Mr. Consing, for giving us an overview and also your own personal views as to how our economy is going to cope in a couple of years. And I don't know if it's encouraging or discouraging to note that it may take us another 1.5 to 2 years to actually some recovery. If you wouldn't mind, Mr. Consing, we would like to have you during the open forum because I know a lot of our participants have some questions in mind. But as you just said, we are going to turn the floor to your Chief Credit Officer, who is also the Senior Vice President of Bank of the Philippine Islands, who will present to us more information as to how the banks are responding to these financial challenges and these waves that are now actually rocking the boat, so to speak, of our hospitals. Are they able to provide more flexible and favorable lending terms to our hospitals and their suppliers in order to carry on with their businesses during this pandemic and post-pandemic? So that's just one of the questions we would like to hear from our next panelists. Ladies and gentlemen, the SVP and the Chief Credit Officer of the Bank of the Philippine Islands, Mr. Joseph Anthony Alonso.
Okay, are the slides up? Okay, can we move to the next slide, please?
Next slide, please.
Oh, great.
Now it's moving.
Okay, okay. In the interest of time, I'll try to go through this as quickly as possible. As I mentioned earlier, we have basically the same criteria we apply when it comes to hospital loans. We look at it the same way we look at other business enterprises. Number one, we look at the sponsors, of course, the investors. Number two, we evaluate the project, the viability of the project itself. Number three, the amount of capital infused by the investors. Number four, the collateral offered. And number five, the prevailing circumstances wherein the project will be implemented. Of course, the other conditions include also the specific purpose of the loan, the amount, the interest rate to be charged. The application of these have been consistent with variations and adjustments only being made when depending on the prevailing circumstances. In the current situation, with the onset of the pandemic, heightened risks with regards to repayment of loans have been observed. Next slide, please. Okay. For hospitals, generation of revenues and income have been significantly hampered due to the general fear of people to visit hospitals, resulting in greatly reduced OPD and admission census, non-operation of clinics, and the shift to telemedicine, video calls, or online consultations. Revenues from diagnostic procedures and ancillary services are sharply down, and elective surgery procedures completely stopped as well. Expenses, on the other hand, are also increasing as measures to enhance disinfection and prevention protocols and frequency of implementation of prevention protocols, provision of PPEs for personnel, and procurement of testing kits and equipment are also driving up operating costs. Fear of contracting the disease not only affected patients, but also hospital staff, resulting in some hospitals closing entire wards due to limited number of nurses and staff. With cash outlays increasing versus minimal revenues coming in, the risks of hospitals defaulting on their loans has multiplied and may even result at worst in bankruptcy for some institutions if not addressed immediately and effectively. Next slide, please. Okay, the causes of financial distress among our hospital clients, ones that we've observed, comes in various forms. Aside from lost revenues and higher expenses due to the pandemic, other risks we see are non-payment for services rendered. Here's where you see most of your clients that cannot afford to pay for the services rendered, issuing PNs, collection of which is still uncertain. And we have extremely delayed receivables collection, most notably from PhilHealth, which has become increasingly common among our clients. And mounting payables to suppliers because, of course, equipment has to be purchased, medicine has to be purchased, supplies have to be purchased, but paying for these has become a burden also. Unutilized expanded facility, as I mentioned earlier, closure of entire wards because of lack of personnel. And for these entire wards or whatever expansions that the hospitals undertook during better times, these may have been funded by loans. Also, of course, there is this increasing demand for hazard pay among our hospital personnel, even the support staff. There are still a great many other causes that may be cited, and the ones I mentioned are the most common that we encounter. There is no generic fix that can be applied to all of these situations since each hospital is unique. So how do we manage these problems, you may ask? Next slide, please. Okay, similar to a hospital setting, we also do a triage. Client in distress is similar to your patient entering the ER. We take patient history, observe and classify whether the patient needs further diagnostic tests, call out to our senior consultants for advice, or the patient is immediately conveyed to the OR for emergency surgery. Generally, those that have the least amount of loans and whose cash shortfalls are only seen as temporary are provided assistance via deferment of loan principal payments for a set amount of time or granted bridge loans to settle critical payables to enable operations to continue. Those that are in the middle of investment or in expansion activities and have already assumed a sizable amount of bank borrowings, as well as payables to equipment suppliers, are in another category. Some may be already experiencing cash flow problems that are making it difficult to continue operating unless immediate drastic measures are implemented. These will require more intensive attention and review, similar to surgery, and will most likely require loan restructuring via a combination of payment deferrals and a detailed consultation to reassess the entire hospital operations, and may involve postponement of planned projects or capital expenditures to save much needed cash. Again, similar to post-op recovery and rehabilitation. Now, totally new projects is another matter, especially during these times of COVID. Well, we also have to study these new project proposals carefully. We understand the need for additional hospital beds that the country like ours is in critical need of. So we, as much as possible, we'd like to support as well. But during these times of heightened risks, stricter lending parameters will also have to be implemented to ensure that repayment will be done. This, however, does not mean that the financing window for new projects is already closed. Rather, we would have to be more discerning in assessing which projects would have the most chances to eventually succeed. What indicators do we look at then? First and foremost, of course, as I mentioned earlier, are the people behind the project. Do they have successful track records in establishing and managing a hospital? Do they form a cohesive group? Will this group that invested into a particular hospital, most of them are highly qualified doctors and specialists in their fields, but could they work together as a group when the hospital goes into financial distress? So we look at that as well. And what is their formula in ensuring the hospital business becomes a success? Do they have a specific niche that they're looking at that they can serve? Is there an area that they feel that is underserved, that in the long run will eventually pay off in terms of providing services to address these needs? Will the project be something that the community would need? Is the hospital that's being put up too ambitious to be placed, let's say, in an area in which the community cannot afford to pay for all these services? So if that is the case, then the hospital would probably be running into financial problems sooner rather than later. How much capital is being invested? The more capital that is invested, the less need for the banks to provide financing. And it also is a reflection of the commitment of the stakeholders in seeing the project through. How much would the loan required? How much would be the loan required, and how long would be the repayment period? We have to work on this together with the project proponents, because we look at the project in a different way compared to the project proponents. When the project proponents would probably say they can repay the loan in 5 years, but in our view, it could be 10 years, so we have to discuss that. Of course, the interest rates would vary depending on the tenors of the loans. Then we also look at projected cash flows. Would these be sufficient to repay the loan? What collateral is there to secure the loan? How much is the lending rate? These are just some of the questions that need to be addressed before financing could be extended. I'm afraid I have to end my talk at this point in the interest of time. I hope I was able to paint a picture of how we view hospital credits in a simple way. In summary, I would say that banks, being fellow frontliners, have been extending assistance to our hospital clients in various ways to support continuous, meaningful delivery of healthcare services while trying to ensure the long-term viability of hospitals as businesses. Let me end by quoting Benjamin Franklin. Next slide, please. He once said that an ounce of prevention is worth more than a pound of cure. This quote is generally believed as relating to medicine, but it was actually intended to address fire safety. By extension, this also applies to business. Identifying and addressing the causes of distress early will definitely help in avoiding much larger financial difficulties in the future. Thank you, and keep safe, everyone.
HealthCore Academy, your reliable partner for world-class healthcare delivery and patient safety.